Good morning. This is Larry Edelson for my Uncommon Wisdom weekly video market update for Thursday, April 21st. Well, this week certainly got off to a bang with Standard & Poor's issuing a downgrade to its outlook for the U.S. Treasury market. Now bear in mind, a downgrade to the outlook is not the same as a downgrade to the credit rating itself. However, this is certainly confirmation of what I've been telling you all along, that this is a sovereign debt crisis. We've seen the sovereign debt crisis already break out in Europe, and now, of course, it is moving to the United States. Earlier this year, I forecast that we would really start to see the giant waves of the sovereign debt crisis hit our shores in the second and third quarters of this year, and that it will last for several years. So that forecast remains on target. And basically what we're dealing with here is governments, not just in the United States, to be fair to Washington, but governments in Europe and in other situations, places like Japan, deeply, deeply indebted, way over their necks, way drowning in debt, and patently unpayable debts. Now, it's really important to understand that the United States is really ground zero for all this. The real estate bubble burst here. That was really, as devastating it was really a trigger for the bigger crisis, which is governments that are for decades have promised more than they can deliver, and now all the chickens are coming home to roost. Let's go right to the charts right now. We're seeing quite a lot of interesting market action, very volatile market action in these markets. I want to first take a look at gold. Gold, as you know, if you've been following my work, did take out the 1463 resistance level. And as you can tell from this chart in here, it is steadily progressing now towards the next level of resistance, which is around the 1550 level up to about 1570 level in the short term. I fully expect that over the next few weeks we could easily see those levels achieved, and going into June perhaps even higher prices close to the $1,700 level. Now, importantly, this is not the big move up in gold. The big move up in gold will come once it exceeds its inflation adjusted price at $2,300, and when it is going up in terms of all fiat currencies, and when the sovereign debt crisis both here in the United States is hitting hard. And I don't expect that until late next year, going into 2015, 2016, when we will likely see the end of the dollar as the world's reserve currency. At that point, going through that process, we will see gold go well over 2,300 to 5,000, perhaps even as high as 7,700 or $10,000 an ounce during that time period. However, for me to put out my final targets, my initial target, as you know, my minimum target all along since 1999 when gold bottomed was $2,300 an ounce. We're getting closer and closer to that. But my longer term targets for what I consider a major peak in gold, which won't come till 2015 or 2016, will be substantially higher than $2,300 an ounce. So let's go on now to silver. Silver, as you know from following my work, I was very reluctant to get involved in silver for quite a long time. I have put my toes into the silver market in here with a position in silver Wheaton. Silver in the short term looks like, of course, it looks very, very toppy, and it's still a very dangerous market, but it could move quite quickly through technical, cyclical and technical resistance at the $44 per ounce level and jump quite sharply to its previous 1980 high at $50 an ounce, while gold is also climbing up to, say, 1,700 by June. Now, the fact that I lifted hedges and we saw gold deliver the breakout signals that I had given you does not mean that there will not be any pullbacks along the way. It's simply along the way higher. It simply means that the most vulnerable cyclical period of the year, not seasonal, because we do have some seasonal weakness going into the summer, but cyclically, trading-wise, weakest, most vulnerable part of 2011 for the precious metals was in the first quarter. And now that we have cyclically and technically broke out to the upside, I believe that eliminates the prospects for what I had originally anticipated as a 20 to 30% decline or pullback in the precious metals complex. So, having said that, keep in mind that these markets are going to be exceptionally volatile, and you should really focus on the long term going out to 2015, 2016, where we'll see gold and silver triple and quadruple in value, and select mining shares and commodity resource stocks do the same over the next 3-4 years, regardless of how underlying economies are doing in the Western world. This is a financial and a monetary crisis and a debt crisis. This really has nothing to do with the underlying economy. The underlying economy exacerbates it, but it's not, the underlying economy is not capable, neither is government, of fixing this crisis. The only thing that's capable of fixing this crisis is a kind of flame out situation where things go crazy and ultimately the entire monetary system needs to be rebooted. And that's what we're going to see happen over the next few years. Let's now move on to the dollar index. The dollar has been meandering back and forth. It's very, very weak indeed. On Monday, when Standard & Poor's issued its warning, the initial reaction for the dollar mystified most people. The dollar actually had a strong rally, which you can see right here. That was simply because nervous investors and traders all over the world, when they heard the Standard & Poor's warning, simply decided to liquidate their riskier assets, and that meant going into cash. And by large part, going into cash still means going into dollars these days, switching out of risky assets and buying dollars. So that gave a little bit of a lift to the dollar on Monday, and indeed we might be finding some support here for the dollar for a possible rally, a short covering rally, a little bit of a relief rally in the dollar index up to, let's say, 7,800, this pink line here. I don't expect much out of any dollar rally. It'll come and go like many other short-term dollar rallies over the last several years. The long-term trend for the dollar is substantially lower. Excuse me. I want to go now to the Dow Industrials. This market has been very volatile. It has been very choppy. Along with the signals I did get in gold, as you've been following me over the last couple of weeks, we did get a close on 2 consecutive days in a row above 12,391 in the Dow, which indicated to me that the potential downside I saw coming in the first quarter of this year for the Dow, down to as low as 9,000 or 9,600, has been basically ruled out. Now, since the Standard & Poor's warning on Monday, we've seen a sharp pullback in the Dow Industrials and in the broad stock markets, but I'm not of the opinion that this is the pullback that I was looking for. This is merely a reaction to the downside. I have many indicators that are telling me that, but the most visual one that I'd like to show you right now is this successive series of green boxes here, rectangles that I've drawn on the chart for you. As you can see, each one of these formations where you don't have a spike high on a bar chart for the Dow was really a pause before an ensuing pullback developed and then a rally to new highs. We have a pause here, pullback, rally to new highs. Pause here, rally to new highs. Pause here, pullback, rally to new highs. Pause here, pullback, pause here, sharper pullback, which created a bit of an isolated low, probably the cycle low that I was looking for, which occurred in mid-March, and then the most recent rally, which did achieve new post-March 2009 crash highs. But notice the bar formation here. you don't see a spike high in the Dow. So that indicates to me that this cluster of trading activity here will be decisively taken out by another thrust higher in the coming days and weeks. That could have happened almost immediately, or it could be a few more weeks and some sideways action in between. However, I would not be surprised, as I warned in my last week update, to see the Dow move up to over 13,000 as we head into June. The only thing giving me a little bit of trepidation there is the fact that the S&P 500 did not give its equivalent signals, breakout signals, to the Dows that I alerted to you to over the last week or so. So that gives me a little bit of trepidation in the sense that I would not go full boat into stocks at this point. I would still, of course, stick with natural resource stocks, especially tangible asset companies and mining shares. I would, however, look on a further pullback in the Dow to expand my horizons a little bit and look at some of the top international companies that should be performing well from their revenues and earnings that they're deriving from emerging markets, which continue to really do very well as far as their economies go. And perhaps next week I'll be able to show you some charts there. The emerging markets, stock markets, are looking like they're going to firm up and head higher into June, quite substantially higher into June as well. By the way, anecdotally, I was in Singapore Wednesday, Thursday, and Friday of last week, and I just can't tell you how hopping Singapore is. The streets were packed, the shopping malls were packed, the hotels were sold out, the restaurants were waiting lines just about everywhere. I've been to Singapore probably half a dozen times in the last 5 years alone, and on this trip I would say Singapore's more robust than I've seen it in at least 5 years, if not longer. Having said that, till next week, this is Larry. Please stay tuned to all of my publications, whichever ones you follow and or subscribe to. Again, this is Larry. Have a good weekend and a very good holiday.